We are joined now by Rupal Bhansali, Global Chief Investment Officer and Portfolio Manager at Ariele Investments. She's a member of the Barron's Investment Roundtable and has been featured among Barron's top 100 women in finance for the past 3 years. Under her leadership, the Ariele International Fund has been classified as a Morningstar 5-star fund, with the Ariele Global Fund classified as a Morningstar 4-star fund. And by the way, somebody I think I first interviewed like 15 or so years ago, Rupal, so we're both still standing. Congratulations. It's great to have you back on the show. Thanks for joining us on CNBC.
Great to be here.
You know, you have said something to the effect of there is a regime change going on in the global equity markets. What do you mean by that, and how is it changing?
Sure. I think the central point is that we are moving from a world of quantitative easing to quantitative tightening. And therefore, what worked during QE, which is when risk-taking was rewarded, in a world of QT, risk-taking gets penalized. So that has significant implications for all risk assets, and obviously equities being the highest risk asset class, but it's also other asset classes like below investment grade junk bonds. It has implications for anything that uses leverage, because leverage is a form of risk. And that will affect, things like private equity, which takes on a lot of leverage. It can affect real estate, which has leverage embedded in the business model. It can affect infrastructure. So this is a wide-ranging reset of risk pricing across asset classes. That's the regime change.
So let's get more into this repricing idea, because the markets have repriced. I mean, we're down, 19% on the S&P 500 from the highs. Global markets have been hit even harder. Have we repriced enough already to match the rate and inflation environment we're in?
In my opinion, not at all. All we've done is give up a little bit of the speculative excess that occurred in 2021 that should not have occurred in the first place. We are at the beginning of, I think, a very protracted and pronounced correction in markets globally. I think the US will lead that correction. It is the most vulnerable in terms of valuations. It is also vulnerable from the point of view of the dollar being extremely strong. And for foreign investors who invest in this market, a weakening of both the stock market and the currency means it's even worse to invest in this country than, say, other countries. Also, the junk bond market and the below investment grade market is the largest in the US. And there, the risk of default and a risk of fallen angels, where the investment grade bonds become junk, is extremely high. And as I mentioned, the thing that I would be extremely concerned about is the repricing of risk downwards, which means the riskiest asset classes get hurt the most. Junk equities and junk bonds are the things I would avoid the most. The place to go to, because again, we are all investors, we have to put money to work, is towards dividend yielding companies with strong balance sheets. And that's an important caveat. It's not the highest dividend yielding stocks, but the ones which are high dividend yielding and the ones which have the resilience of the balance sheet and the business model that those dividends will sustain. In past market corrections, when we had a lost decade, which is when the markets end lower a decade from now compared to where they started out, which is what I forecast is extremely likely in the current environment.
Rupal, I'm not going to ask you to necessarily name specific names. You can certainly if you want, but can you give us an example maybe of a company or companies that would meet that sort of thing? Strong balance sheet, high dividend, but not sky high, because sky high tends to imply that maybe they have other reasons they need investors to come in.
Absolutely. So I think, not just a couple of companies, but I think generally speaking, European companies tend to be higher dividend yielding, partly because they tend to be multinationals with more resilient operations and stronger balance sheets. And they tend to have, family owners and founder-owned companies where dividends are a very important stream of revenues, cash flows for them. And so Europe is full of such high dividend yielding, strong balance sheet companies. In particular, I would call out some of the pharmaceutical names in Europe because healthcare will prove to be defensive against what I think is a very high probability of a hard landing all over the world from an economic standpoint. So companies like Roche, companies like Sanofi, GlaxoSmithKline, Novartis, these are some of the Swiss, French, British pharmaceutical companies. all of them have a dividend yield somewhere between 3.5 at the low end to really 4 or 5%. And I think they will be quite secure in the coming years.
Sounds like you're not too scared off, Rupal, by the energy crisis that threatens to put Europe into a recession or worse.
I think as contrarian investors, one should look for the opportunity in the volatility. I agree with you that the energy crisis is quite acute in Europe, but it disproportionately affects the manufacturing sector and certain industries like the auto industry and so on, and the chemicals and aluminum industry. But in terms of healthcare, the manufacturing is not really energy intensive. And the demand for healthcare products does not change with an economic cycle or with inflation, which is why I think that you get more bang for your buck if you try to secure the dividend yielding kind of stocks that I'm referring to in the healthcare sector. You can avoid, again, the worst effects of both high energy costs and inflation, and you can still get strong dividends which provide income when European interest rates are so low.
It's clear you think the U.S. macro market has more downside move to come. Is that a fair thing to say, Rupal?
Yes, absolutely, and a pretty significant one.
Wow. How significant?
Well, at a headline level, if you think about the Schiller PE multiple, which I think is a good reference point, we started out, I think, in the first half of the year at about 30 times PE. The average tends to be about 15. Even if it just moves to the average, you're talking about a 50% correction before even earnings have reset downwards, which I expect to happen in 2023. If the valuations overreact, and typically bear markets they do, you can get to a low multiple of 10 times. Again, these are not forecasts. These are just, if you look at how historically markets behave when they come from a point of excess, which is clearly what happened in 2021, usually from that high watermark, the corrections can be quite severe. That said, during those corrections, you can have some significant bear market rallies. Keep in mind, when the NASDAQ corrected 78% post-2000 during the tech bubble, it had 7 20% plus rallies during the 3-year period, even as it corrected 78%. I think the quarter-to-date rally that we've had is one of these kinds of bear market rallies. And here is another regime change. Instead of buying the dip, people might want to think about selling the rip.